Good afternoon, everyone. Great to be with you again. Very glad to see you. Brad Macbeth here for the Simple Plan Live. Today, we're continuing on in our 7-part series. This is the last week, week 7 of 7 Steps to Retirement Security. Don't worry, retire happy. And step 7 is how to use your home equity wisely. We're going to take a look. A lot of people do that or think about that. We want to look at the perils, pitfalls, and possibilities of using your home equity in retirement. And so this is week 7. We've been all the way through. We've looked at having a plan for retirement, maximizing your government benefits, CPP/OAS, considering a hybrid retirement, which is very popular these days, protecting our savings from inflation, and unfortunately inflation is very popular these days as well. I anticipate we should hear very shortly the US inflation numbers coming out for the last month. I think they're probably going to be up well over 8%. And we're also going to see interest rates climbing as well in an effort to combat that inflation. Here in Canada, we'll see interest rates rising. That's set to be announced in about 4 days. Step 5, you want to secure guaranteed retirement income. Especially important if you want to be sure you don't run out of money. And that is the number one fear that Canadians express when asked about their financial interests and concerns. Their greatest concern is that they run out of money, especially run out of money in retirement. And number 6, we talked about last week, which was planning for long-term medical costs and long-term care. And now, finally, week 7, we're going to look at using your home equity wisely. I want to thank the Simple Plan community on Facebook for sponsoring us this week again. We invite you to join the Simple Plan community, facebook.com/groups/Simple Plan community. It's free to join, and we'd love to have you. We cover all these topics. We dig deep into them. We look at specific examples. We get into people's individual specific questions for their own lives. It is fantastic to have a community of like-minded people with similar goals to do the best for their families' financial security and financial future, to have that kind of a group to walk together with through all of this. So join us there, facebook.com/groups/Simple Plan community. So let's get right down into it and look at accessing the equity in your home. Now, what do we mean when we talk about that? Well, we mean a couple of things. First, that you own a residential property. Hopefully it's all paid off when you hit retirement, but even if it's not, if there's some limited amount of mortgage remaining, you may still be able to access equity in your home. So there are really, there's a few ways that you can access equity in your home. You can sell, of course, your current home and downsize your living accommodations and move into a smaller home or a townhouse or a condo. And again, that can have pros and cons to it. You can remain in your current home and take out a home equity loan, sometimes called a HELOC, which stands for a home equity line of credit. Those are getting more challenging to obtain. Lending is tightened on those. The amount that you can take out is tightened on those. But still, that can be a good option. Now with that, we'll talk about that in a minute. And then you could stay in your home and take out a reverse mortgage. This is probably something you've seen advertised quite substantially on television with gray-haired spokespeople, many of them celebrities, who, if they're having to take out reverse mortgages, then they've obviously done a very poor job of managing their finances because they've made millions. Similarly, there are kind of well-known national financial gurus who advocate for these or advertise for these. Take it with a grain of salt. There are some upsides to reverse mortgages. There are some real perils of them. And so we're going to take a look at some of the specifics. And oh, look, we've got it there twice. Sell your current home and rent a home, apartment, or, oh, sorry, no, the fourth choice is to sell your current home and just rent a home, an apartment, or a condo. So let me just kind of address some of these, and then we're going to drill down into looking at the reverse mortgage. So selling your current home, downsizing your living accommodations, and purchasing a smaller home or condo. That gives you whatever equity comes out of that transaction. So let's say you own a home that's worth now $800,000. It's unbelievable that I use those as kind of typical numbers now, but I live in Kelowna, in the Okanagan in British Columbia. That's where things are at here. Things are higher down in the lower mainland of British Columbia. Things are higher in the Greater Toronto area. Now, if you're in some other cities, those numbers may seem high. But let's say that we've sold our home and we've extracted $400,000 in equity from it. You can take that equity, and bear in mind, we've talked before about guaranteed streams of income. You could take that and turn it into an annuity, and that's going to give you a monthly payment. Or you could keep it as a lump sum and invest it carefully so that it's not going to lose money, and draw money out of there periodically or systematically, whichever you need. The beauty of the equity coming out of your home is there is no tax owing on that. In Canada, if your home has risen in value, you do not pay tax on the gain. That gain is called capital gains. Now, that may change in the future, but that's the way it is, and that's the way it's been for quite some time. Now, that can be a downside to selling your home because typically you're getting 4 to 5% rate of return on a home, on home equity, or the capital cost of your home, and that growth is tax-free. So now you've reduced the nature of that investment. So that's probably the only downside to that approach. Of course, there are also usually costs, kind of double-barreled costs. There's transactional costs for selling your home usually. There's at least some. If you're not using a standard realtor, you can save some money there, but $800,000 house, you could have $20,000 to $30,000 in sales commission fees, as well as all the transfer costs. And when you go to buy a new place at least in British Columbia, now this isn't the case in other provinces, but in British Columbia, we have the beloved property transfer tax, where you're going to pay 1% extra on the cost of whatever you're purchasing. So that's the pros and cons of that approach. Remaining in your current home and acquiring a home equity line of credit. Well, a home equity line of credit bears some similarities to a mortgage in that there's a capital amount that you are extended, and you get access to that. You don't necessarily have to draw it all. So it's like they've opened up a giant credit card that the balance is attached to your house. Now, you will at the very least have to make interest payments every month on that. So it requires some cash flow in order to fund it and keep it going. And generally the rates on that vary. And as I noted at the beginning, interest rates are increasing in Canada right now. And so those rates are moving up well into the 5% range right now, which is similar to where 5-year fixed rate, 5-year term fixed rate mortgages are at right now. A few pitfalls you have to watch out for in the home equity line of credit. Now, again, you're going to be able to access the money tax-free because borrowing money, we don't pay tax on borrowing money. Now, you have to be very careful, and you have to really be aware of the fine details of the home equity line of credit for whatever institution you're using. Some of them, as long as you have made your interest-only payments, they cannot change the terms and conditions of your home equity line of credit. But there are some out there from some of the major lending institutions, RBC being one of them, where, and I think others are like this as well, where they have all the ability to change the terms of your HELOC. So they can cap it for example. They can just say, we're not extending anymore. They could call it and say, well, no, you need to pay some of this down, or begin making larger payments, or what have you. So that there is some risk there, because you can't be certain what's going to happen. So for example, when there was the great credit crunch back in the 2007, 2008 era, banks started tightening their lending policies, and as lines of credit were reviewed, lines of credit could be called, or at least tightened. Again, they have a floating rate, so you don't know exactly what's going to happen with the interest rate there. And you have to be able to manage the interest-only payments no matter how high the interest rate goes. So, some upsides, some downsides to the home equity line of credit. Stay in your current home and take out a reverse mortgage. We're going to look at that in details in just a moment. And you can sell your current home and rent a home or apartment or condo. Now, of course, the other thing you could do, I didn't put it in here, but you could turn yourself into a landlord and you could rent out your house and take that revenue, the net revenue that comes from that, assuming there is some, and live on that. That would be income to you, and you have to figure out whether there's enough there to make it worthwhile. Also, there's what my former late father-in-law referred to as the PETA factor on this, which is the pain in the arse factor of being a landlord if you do that. And if you're getting older, then you're probably going to want to have someone who can handle some of the stress of that for you. Now, let me say first off that life is better and much more simple and flexible if you don't need to access the equity in your home as part of your retirement plan. So you can move, downsize, upsize, whatever size you want, without having to concern yourself, or stay put without having to concern yourself about your finances. But a lot of people haven't saved enough outside of their home ownership to fund their retirement. Also, of course, there's a lot of money accumulated in some people's homes over the last 5 years in Canada, and more in some jurisdictions, but all over Canada over the last 5 years. So many people want to access that. So the reverse mortgage, some of the conditions of it, the homeowner has to be at least 55 years of age. That's a regulatory requirement. The loan is not repaid until the last homeowner moves out of the property or passes away. So you have to stay as an occupant of the property. This is one of the kind of velvet handcuffs you get put in with these reverse mortgages. You must be in the home as a resident. You couldn't move out partway through and go live somewhere else and then rent it out, for example, without paying off the reverse mortgage. You have to stay living in the house in order to maintain the reverse mortgage. And of course, you want to understand the fees and the restrictions. And we're going to take a look at that. We're going to take a look at some of those aspects right now. There are really two primary, there's may well be others, two kind of primary reverse mortgage lenders in Canada. One is called CHIP, Canadian Home Income Plan. That's the one you would have seen advertised on television. And then Equitable Bank also offers the reverse mortgage. So I just want to go through their site a bit. I'm not advocating for one over the other. They just have the information more readily available for this presentation for us. So here's their stipulations for a reverse mortgage. You have to be at least 55. For them, you have to live in Ontario, Quebec, BC, or Alberta. Your home has to be your principal residence, and you have to live there for at least 6 months of a calendar year. So if you're a snowbird, you need to not be out of the country for more than 6 months, of course, and you can't be in the United States if that's your snowbird destination for more than 6 months, and for the home equity, or sorry, for the reverse mortgage, you would have to be resident in your home for at least 6 months of the year. Everyone who's on title has to apply as joint borrowers in Ontario, Alberta, and BC. Can't be a secondary home or cottage. It's got to be your principal residence. And it's a detached, semi-detached condo or townhome. That means you couldn't, for example, use a mobile home for this kind of thing. So those are the basic requirements. There generally aren't requirements around credit. Now, if you had terrible, terrible credit, then they may question whether they're going to advance you the money. But this is just fully an equity-based loan. You're not qualifying based on your income because you're not going to make any payments. With a reverse mortgage, you don't make any payments. The reverse mortgage is paid out, the principal and interest owing, because the interest owing accrues. There's no monthly payments. Everything gets paid out when the home changes hands, which means you've either moved out, which means you've had to divest of the reverse mortgage, so perhaps you've sold the house, or you've passed away, in which case the house is sold, or it may be passed along to somebody else, but they have to get their own financing on the house. So those are the basic conditions. So let's look at some of the different conditions or terms for some of their various products. So we see they have different products that with different percentages of how much you can borrow. You can get almost 60% on their Flex Plus plan, 15 to 55% on their reverse mortgage Flex, and on Flex Lite, 15 to 40%. The minimum appraised value of your home has to be $250,000. There's a guarantee on these that you can never owe more than the fair market value of your home. So essentially what that means is whatever you could sell your house for, you cannot possibly owe more than that. So the worst case scenario when you leave the home is that you wouldn't take any new equity with you. They insist that you get independent legal advice, so you have to talk to your own lawyer. And the options for how the money is going to get advanced to you are, it does require, in this case, I believe, an initial advance of $25,000 minimum. Then you can go on and get single, or what they call ad hoc advances, kind of like a line of credit when you want to. You can also get scheduled advances. So you can get monthly money flow coming from that. Again, the money from this is not going to be taxed because you're really just borrowing your own money. And when you die and everything pays out and the equity comes out, still, of course, you won't pay tax because the equity in your home is not taxable if it's your personal residence. So cities in most large towns, this is something you have to watch out for. Cities in most large towns across Ontario, Alberta, BC, and Quebec, depending where you live, you may not qualify if you're in a smaller center, depending on what province that's in, and so you need to check for that. Now, a few things to be aware of. They have prepayment charges. So let's say you're in this deal and you decide you want out for some reason. And you're not selling the house. Well, you're going to pay a prepayment charge, and that is 5 months or 4 months or 3 months worth of interest in the first, second, or third year. So what that means is in the first year you'd pay 5 months interest, in the second you'd pay 4 months interest, in the third year you'd pay 3 months interest. In years 4 to 10 you pay 3 months of interest. After year 10, there's no penalty for prepayment. And they note here as well that actually 6 years after the fact, or once you're into it for 6 years, you can prepay the entire balance with no charge with 3 months written notice. Now, these are the current terms and conditions. At the time that you're doing it, you would have to check. Now, setup fees and other fees, this is one of the things going on with these. You're going to pay a $995 setup fee. You're also going to pay costs for putting the mortgage in place, or what they call conveyancing, same as you would if you put a mortgage on your house. Reverse mortgage, pay the same thing. You're going to go to a lawyer or notary's office, sign a bunch of papers, and there's going to be some fees for that, legal and closing costs. Plus, you're going to need to pay for your independent legal advice. So, you can probably guess that all of that, including the setup fee, is going to run you somewhere around, well, between $2,000 and $3,000 in fees. So not cheap, but not unlike a mortgage in a lot of ways. So now let's have a look at what's happening with their rates. So what do these rates look like? Well, like a mortgage, you can get different types of terms. You can have fixed rates, and you can have adjustable or floating rates on your reverse mortgage. So you see here we've got the $995 setup fee. Right now their 6-month fixed is 6.39. Now they, as mortgage lenders, are required to disclose the annualized percentage rate, which means it's not just about the interest, it also amortizes the cost of the fees over the period. So what that means is the APR is actually 8% on this. Now you get this same disclosure in a mortgage document as well. So this isn't any different than a standard mortgage, the fees may be a little different, but this type of disclosure and these types of discrepancies between the mortgage rate and the annual percentage rate are the same in mortgages. Now we'll notice that these these interest rates are a little higher, well, significantly higher, in fact, than standard mortgage rates. Because right now you're looking at just maybe 5 or a little over 5%. You might find some as low as 4 3/4, 4.5 even, on a 5-year fixed mortgage, whereas you're almost at 7. And again, I believe in the next 5 days that interest rates in Canada are going to go up again, and you're going to see that all rise by at least 0.5 point, maybe by 3/4. Now, of course, you can go with the adjustable rate mortgage or reverse mortgage, which is prime plus 2.29%. And I think these guys have their own prime, which is the way most of them run that. So you're looking at another, I think 3.7, so maybe 5.99. So about a percentage point lower for the adjustable rate. That's for the reverse mortgage flex. And then, of course, there's the flex plus and the flex light, and they have slightly different rates or somewhat different rates. So it gives you an idea. This is going to accrue, and it's going to chew away into the equity in your home over time. So let's take a look at what this looks like. Now, again, I chose this site just to get the quotes, because on the other company site, CHIP, you have to give them your personal information, like your phone number, your email address, your name, and all that, before you can even see what it might cost you. Here, that's not the case. So let's just step through this. All right, so how old are we? So let's say we're 65, and we live in Ontario. Okay, pick a name. Let's go with Windsor. How much is our home worth? Well, let's say it's worth $750,000. Okay, so we click next. And so interestingly, they say you could be eligible to borrow a maximum of $255,000. Well, $255,000 divided by 750, that's only 34%. That's interesting. I don't know the ins and outs of how they come up with these numbers, but that's what they're saying. And so how would we like to receive our money? We would like to receive it spread out over time. So let's say we don't want anything. Is that possible? No, you have to take $25,000 as the minimum to start. They want to get that interest clock running. All right, so we take out 25,000 and we're going to schedule the rest monthly. Okay, so let's say we want $2,000 a month. How's that work? And we want it for 30 years till we're age 95. Oh, the value entered is too high. Total request exceeds eligible amount. Okay. So we'll just adjust the number down till we get to a point. Whoop, ran out of gas there. Till we get to a point where we haven't exceeded. There we go. All right, so 15,200 left. So somewhere around 12, I'm going to guess 1280. All right, so that's about right. So 1,280 is the limit of what we can do and we've got $750,000 of equity. So what does that come out to? 1,280 monthly. Let's see. So that's 15,000 a year, 15,360 divided by 750,000 means we're only getting 2%. So if we had that 750,000, we sold our house and took 750,000, 2% return would be getting us that 1280 a month. Okay, so let's see results, what all that means. So they're recommending their particular product. So let's see what that looks like. So this only goes out 15 years because I think their term is 15 years. Presumably you'd have to renew. So after 15 years, they're projecting a home equity amount. So if we sold the house after 15 years, in the year 2037, we would have paid, what have we got here, 254,000 we would have received, and we'd owe interest of 177. So add on the remaining equity, you can add on, what's that, 431, about 432,000. So they're showing our, oh, there you go. At the end of 15 years, they're showing our home values 1,168,476. So, you know, you started out with 750 and you're only down to 736. That's not the worst result, but it's expensive compared to just going and getting 2% in the market out of our 750,000. However, we've had the advantage of continuing to live in the home. So you have to really weigh whether that makes sense for you and your situation or not. Let's see what happens if we download our report. I bet it's going to ask, oh, look at that. They don't even ask for our email address. They get bonus points for that. So you would be able to download your report, and then you can read all the fine details that they provide there. It shows you a table of what they're planning, that kind of thing. So yeah, you know, you can, in fact, let me put that, let me put their site in the comments there for you to access. So, you know, it gives you an idea of how that's all going to work. You can go and check for yourself. Oh, again with the red lettering. Let's just move that on the white background there so it's easier to see. Put it back there again for just a minute. Okay, so that gives us an idea. Now, by the way, there's also a Government of Canada site that talks about reverse mortgages. So I'll put that there for you as well. You can go see what they have to say about it. I'm not a huge fan of reverse mortgages, honestly, but you know, if you haven't saved enough and that's what you've got for money, then so it goes. You know, that gives you the flexibility to remain in your home, not have to sell your home in order to gain access to that equity. So just a quick review there on the reverse mortgage. It can make sense if you have a high degree of equity in your home. By the way, if you don't have your mortgage already paid off, there's an existing mortgage on there, you would have to it'd have to be small enough that you could use that initial advance money to pay off your existing mortgage. You can't have an existing mortgage at the same time that you have a reverse mortgage, primarily because the reverse mortgage would have to go in what's called second position, and they won't do that. I highly recommend that you consult with a financial advisor about it before you enter into a reverse mortgage, because you want it to be part of an overall comprehensive financial plan to see whether that makes sense or if you must do it, or at least to fully understand all the ins and outs of what you're getting yourself into, because you are going to have less flexibility once you take that out. And you just want to understand what that's all about. So a reverse mortgage can make sense if you have a high degree of equity in your home. You plan to stay in your home as your residence. Have to emphasize that. You have to live in the house. And if you don't have enough income to meet expenses and you don't have another way to generate that income. Okay, so that covers really all the ways in life that we can end up with financing our home for retirement. I would, again, reiterate, you want to avoid that. Let's go back to our 7 steps. We want to get on top of this and have a plan for retirement early enough that we can avoid step 7 of having to be wise about using our home equity. The wisest thing you can do with your home equity is don't use it. Or find ways, if you're going to use it, not because you have to, but because you're going to do things that you really want to. So that covers the spectrum of that notion of using home equity wisely in retirement. I'd love to answer your questions if you have any. I want to thank again the Simple Plan community, our sponsor for today. Facebook.com/groups/Simple Plan community. Come join us there. Walk together with like-minded people who are seeking to do the most with their financial future and financial security for their families. Also, I invite you to subscribe to our weekly update at go.getthesimpleplan.com/subscribe. We have tips, tricks, tools in there weekly. We also have links to all our broadcasts that happen every week, and you can also find out what's coming up as the topic for next week. That's go.getthesimpleplan.com/subscribe. Lastly, if you'd like to talk about these things, I'd love to meet with you. Happy to have an exploratory conversation so you can get to know me, get to know our team. We can get to know you and see if we might be able to help you with some of these steps on your road to the 7 steps to retirement happiness and security. Don't worry, retire happy. You can book a time at go.getthesimpleplan.com/calendar-new. That's go.getthesimpleplan.com/calendar-new. And I'm going to put all those in the comments again. If you have any questions about these, feel free to send them to us. Come on into the Facebook group and bring them. whatever floats your boat. We'd love to meet with you and talk to you as well. So there's in the comments how you can get in touch with us to book a time. And just go to Facebook, and you can also join the group. We'll add that to the broadcast there. I want to thank you very much for being with us again. We really treasure this time we have together every week. If you're wanting to book a time, I encourage you to get on top of that today, because we are going to be away for a few weeks coming up in the summer. So we've opened up some extra slots in the next 2 weeks to be able to meet with folks. But those spots are filling up fast, and after that is probably going to be another month before we'll have any new slots. So thanks very much for joining us today. Great to be with you. Next week, we're going to be looking at the intriguing topic of, can you really get life insurance premiums back so that your life insurance over a period is ostensibly free? There are products like that in some countries. We don't have them specifically here in Canada, but there are ways you can set things up so that that number one complaint people have about life insurance is, I pay all these premiums for term insurance and then I don't get any of my money back. It's just all gone. There are ways to arrange things so that you actually can get the cost of that policy back. Join us next week. We'll be taking a close look at that. In the meantime, have a great week. Thanks very much for joining us.